Hello and welcome to this Q2 2022 update for the AJ Bell Managed Portfolio Service. My name is Jamie Ward and I'm Head of Investment Solutions here at AJ Bell Investments. Possibly an unfamiliar name and face to most of you, but hopefully the presentation will be fairly familiar. We'll kind of run through where we are as a business right now, and maybe talk a little bit about the performance of the various MPS products, give you a review of what's been going on in the markets and what's been driving that performance, bit of a portfolio performance review, active versus passive, that kind of thing. Then a little bit of an outlook on where we see markets going and what are the big factors out there right now. And then I'll just round it up for you. So we've been going just under 6 years now. We were set up as a business to build and manage investment solutions for people on the AJ Bell platform. We're currently just over 2.5 billion. That's grown by about $250 million over the last 3 months. And we have a wide range of investment solutions. We run 9 funds with 6 risk profiles, 2 income, 6 growth, and 1 responsible. In addition, we run 28 MPSs. Now that's basically 4 lots of 6 risk profiles running from what we call MPS 1 to MPS 6, MPS 1 being the lowest risk, MPS 6 being the highest, but with 4 different implementations. So we have a passive implementation, which largely uses ETFs, an active one, which uses active funds, a Pactive one, which is our blended version, which combines both passive and active, and then we have a responsible range. In addition to that, we have 4 income MPSs. They run across 2 of the risk ranges, which is equivalent to our MPS 4 and 5, but we just have the 2 implementations for that, one active and 1 passive. So generally, performance in MPSs over the last 3 months has been poor in absolute terms. In relative terms, we've actually done quite well, and we'll talk a little bit about that, reasons why. But the general theme over the last 3 months is that markets have been very, very poor for all asset classes. So there hasn't really been anywhere to hide. The only thing that's quite unusual about the performance over the last few months is typically what you'd expect in performance is the ones with the largest performance, whether that's negative or positive, would be the highest risk ones, which would be our MPS 6. And then the ones with the lowest absolute performance, whether it's negative or positive, will be in the lowest risk MPSs, which would be MPS 1. What you'll notice here is MPS 3 has actually outperformed both MPS 2 and MPS 4. And what that's reflecting is that MPS 3 is sort of in the sweet spot where it's managed to capture 2 of our portfolio tilts that have done well over this period of time. The other thing to note on this slide is you can see that the income funds have done better than their equivalent growth funds. So the equivalent growth fund for MPS Income 1 would be passive MPS 4, and then the MPS Income 2 would be passive MPS 5. And what's happening there is income funds are naturally going to be biased towards value stocks, because value stocks are where a lot of the dividend yields are. And consequently, they're in that part of the market that's done quite well. Talking about the active, the performance on the whole has been worse. Active managers have really struggled in this environment. Again, we're outperforming the peer group, we're outperforming the index, but it hasn't been a fun time for active investors. And also, once again, you see the same trend with MPS 3 doing better than MPS 2 and 4, and the income funds doing better than their like-for-like growth funds. Again, Pactive doing a similar sort of thing, but Pactive, as I mentioned earlier, is a blend of the passive and the active. So it's sort of hits that midpoint between the two. It's really designed for people who don't necessarily want to go full passive, but don't necessarily want the fees of full active, but they want to continue sort of having a bit of an active allocation. So let's talk a little bit about what's been driving market returns over the last 3 months. That top left chart there is basically telling you that over the last few months, that value has been the big growth driver, or the big performance driver rather, in the equity market. That's a continuation of what's been happening in Q1, and it's beginning to look a bit more of a trend since the end of Q4 2021. That central one, that's basically telling you that government bonds have been a better place than high yield bonds. Higher quality bonds have been better than lower quality bonds. And this is a sort of a theme you'll see throughout the rest of the presentation. And then finally, that one on the right, that's basically saying that large cap has been marginally better than small cap. Now, that's not true globally necessarily, but there are pockets where the large caps have done better. If you think about in the UK, we're quite heavy in oil and gas, quite heavy in financials, but in the US, it's quite tech heavy. So in the US, actually, the large caps have done quite poorly. But overall, there's been a slight bias towards large cap. On the market as a whole, anything with a dollar exposure has done very, very well. We're in a period of great uncertainty right now. We'll talk about that a little bit further on in the presentation. But during periods of great uncertainty, what often happens is capital will flood towards that area that is considered safe. And for whatever reason, dollar is considered the safe asset right now. That second chart is telling you that in the bond market, you really want it to be in the short end of the yield curve. That means you want to be in bonds that are going to be maturing sooner than the ones that are maturing later. And it's been really quite a stark outperformance in those short duration assets compared to the long duration assets. And that's, again, it's a similar trend to what had been happening in Q1, but it's possibly been exacerbated into Q2. The third chart is saying that the best place you really wanted to be was bonds, but really there hasn't been a good place, there's just been a relatively better place. That is to say, for the most part, you haven't done well in bonds, you've just done better than being in equities. And that's really what's made it such a difficult market to be invested. And then finally, there is a very slight bias towards emerging markets outperforming developed markets. What's actually happening there is China, which is actually the largest emerging market, has outperformed quite significantly. The other emerging markets are more or less in line actually with the developed markets. So that slight tilt towards the emerging markets in performance is actually being driven by just China. So let's talk about the economic backdrop. Well, geopolitics is very, very fraught. Obviously, we've still got the ongoing situation in the Ukraine. In the UK, Boris Johnson resigned recently. But if you wanted to be parochial, you could sort of say, well, that's sort of typical UK politics. But actually, if you look further afield, what's been happening in the UK is not untypical of what's been happening in the rest of the world. Not always exactly the same, but a similar sort of flavour, if you like. In France, Emmanuel Macron has effectively lost his mandate, having lost the majority in the House over there. In Italy, Mario Draghi has kind of got an off-again, on-again relationship with being Prime Minister. He was forced to return from the G7 in Madrid to deal with protests in Italy. And eventually he resigned as Prime Minister, only to have his resignation turned down by the President. He's subsequently written a letter saying he intends to resign once he can get through the protest period. But either way, Italy is looking quite fraught also. In the Netherlands, there has been regulation placed upon the farming sector, which the farmers saying is going to make their business unviable. And this is all about the kind of socially responsible area of the market, whereby the Dutch government is trying to impose what is considered more environmentally sustainable practices on the farming sector, but with very little transition period. And what that's led to is farmers protesting en masse and trying to close down commerce in the Netherlands. And we've had a little bit of that coming into Germany also. Further afield, there's actually a very similar thing that's happened in Sri Lanka, where a similar sort of policy had been put in place against the farmers, and the farmers saw that as an attack on their economic well-being. What that's led to is actually basically an overthrow of the Sri Lankan government. And then finally, if we go even slightly further afield, in Japan, Shinzo Abe, the longest-serving prime minister in Japanese history, who had resigned in 2020 to deal with cancer that he was suffering at the time, was on the campaign trail in the city of Nara and was assassinated. So we're clearly in very, very unusual times. The politics of the world are clearly very fraught. And the thing is, when politics are fraught, markets can be very, very weak. Markets like certainty. Markets like to be able to understand what tomorrow is going to look like. And when geopolitics becomes fraught, then that certainty disappears and markets decline. But really what we're actually seeing is an acceleration of existing trends. We'd already seen some of this in the first quarter of last year. I mean, clearly, the first quarter of 2022. clearly the Ukraine crisis had already begun then, but you could see sort of the start of geopolitical issues in various countries already beginning. And overall, this is leading to both economic and market volatility. Economic in that it's becoming very, very difficult to predict what the next quarter might look like with regards to growth or inflation or whatever it happens to be. And economic volatility begets market volatility. And that seems to be very much a trend of what we're seeing at the moment. In the equity market, what that means is basically there's nowhere to hide. Across the board, you've lost money. And I recall I did mention that emerging markets have been slightly better, and you can see that on this chart with emerging markets being that second one. But if you take the positive performance from China, which was up 8% through the quarter, EM is considerably worse than what it appears on there. So actually where you want it to be is possibly the UK, which has been unusual for the last 10 years, where the UK has been quite a poor place to be. And the reason for that you can actually see in the following slides, which is around the factors. So we look at high dividend, low vol, and value. These businesses tend to be, mining companies, oil companies, financials, consumer defensives, utility companies, all of which, well, with the exception of mining, which we'll talk about in a moment, but for the most part have done very, very well in this environment. And the UK is very heavy in that. So it's not the UK bias that's done well by being in the UK. It's the fact that the UK is heavily towards these factors that's contributed to that. And if you recall from the previous slide, that the US was the worst performing area. Well, the US is very heavy in growth companies. It's very heavy in momentum companies, which is basically the same sort of thing. And it's quite heavy in what you refer to as quality. If you drew a Venn diagram for growth, momentum, and quality, there's a big overlap, and a lot of it's in the US. And finally, you can see in the sectors on equity, there has been pockets of positivity, but they are very, very slight. Fortunately, on our MPSs, we have in the higher risk ones a tilt towards the energy sector, which has helped it with our relative performance quite a lot. Energy has clearly done quite a lot better than most of the sectors, but actually first quarter it was even better relative to the rest of the areas. But overall, you've lost money in equities. The key thing to take away from here is the basic materials. Now, basic materials sits second from the right there, down 13.4%. Now, basic materials have and are typically very high dividend yield areas and very much a value area of the stock market, yet they perform very poorly. What's happening here is the underlying commodities that make up these mining companies' sales have declined quite precipitously. So what we're probably seeing there is we are certainly in some form of slowdown and possibly even a recession already. It's just it hasn't started to appear in the official data yet. This could be considered a bit of a leading indicator of what's been going on with the economy globally right now. Moving on to the bond market, you've made money if you have owned the shortest duration assets. What that means is those bonds that are maturing soonest, but you've lost quite a lot of money if you've had long duration assets. What this is called is a steepening of the yield curve, and it could coincide a little bit with what's been going on with the mining sector. The yield curve was what's known as inverted, and it still is inverted over the last few months. And an inversion in the yield curve is sometimes thought of as a harbinger of economic difficulty. Now, as you go into that economic difficulty, we sometimes get something that's known as a bear steepener, where the yield curve steepens because the yield on the longer duration assets go up and the yield on the shorter duration assets go down, which is the inversion of what's happening with the capital you can see on this chart. If we move on to the difference between active and passive, it's been very, very difficult and unusual markets generating quite unpredictable returns. We already talked a bit about the MPS 3 there. Now, in our portfolios, we have a tactical overlay that allows us to tilt the portfolios away from risks that we consider to be too high. And how that's manifested in the last year is we've been shorter duration biased in our fixed income. That's not to say we don't have long duration. It just means that we are typically tilted slightly more towards the short duration end of the yield curve. And in the equity portion, we're in those more value areas, particularly energy. So on our lower risk portfolios, we've outperformed because of the short duration bias. And in our higher risk portfolios, we've outperformed because of our energy bias. That MPS 3, which you'll notice did very well compared to its sort of MPS 2 and 4, is exactly in the sweet spot where it's got a little bit of the short duration bias and a little bit of the energy equity bias, which has allowed it to give that higher performance and hence generated these slightly unpredictable returns. It's been a difficult period for active implementation. Typically in the equity sector, active managers are heavily biased towards value, so they should do better in value environments. Unfortunately, they've been biased away from the energy sector for various reasons, mainly related to environmental, social and governance concerns that overlay a lot of the funds these days. Overall, however, both of our styles have done quite well against the peer group and the sector. And as I mentioned, both the short duration in the fixed income area and the energy exposure in the equity area have continued to help in that trend. So let's talk about some of the highlights. Very few in active, but we did have exposure to Chinese equities and the higher risk ones, which, as I mentioned earlier, was up around 8% during that period. And there was also a few areas where there was okay performance. So we have an exposure to index-linked bonds. Inflation-linked bonds rather. And you'll doubtless be aware that the inflation rate has spiked to levels we haven't seen in quite a long time, and therefore those fixed income elements related to inflation have done quite well. Detractors, unfortunately, are a much larger area, but broadly, it's those areas that are exposed to growth, economic growth. So big equities in your Facebook, Google, Alphabet. So US tech has been quite poor, but also US smaller companies. And in the fixed income area, as I said, we're biased towards short duration and biased towards higher quality, but we do still have exposure to higher yields and longer maturities, and those areas have been really quite difficult to sort of keep up. On the income model portfolios, it's been poor in absolute terms, but once again, as with the first quarter, better than the equivalent growth portfolios. And that's because of this inherent bias that an income portfolio will have towards those parts of the market that have been doing quite well, like the energy sector. Now, a lot of that performance basically means that it's been driven by missing the worst. You don't tend to be quite very exposed to fast-growing tech companies in an income portfolio because there's no income there. So we've missed out on the negative performance in those sorts of securities. So that's sort of why the income portfolio continues to do well compared to the growth in this year. So looking a bit further out, it seems that geopolitics is at a low, but it could still be worsening, and that's driving both inflation uncertainty. And inflation uncertainty are anathema to positive market returns, whether that's in fixed income or equities. Over the long term, we maintain that equities look more attractive than fixed income, but equities by their very nature are what's called long duration assets, which basically means they are more exposed to the movements in interest rates than an equivalent bond. So that means in the short term, they look like a difficult place to be invested, because as inflation continues to sort of surprise on the upside, then expectations of interest rates will continue to surprise on the upside, and therefore equities continue to get hit on those days. Overall, despite the fact fixed income has performed slightly better than equities during the quarter, that gap between the valuation in fixed income and equities has actually narrowed slightly. So whilst it's true that equities remain more attractive on the longer term view, fixed income on a relative basis doesn't look quite as bad as it did, say, 6 months ago. And finally, unfortunately, it's looking like a recession is very likely. We could even already be in it. If you want to keep up to date with the rest of the portfolio, the rest of what we do, then if you go on to AJ Bell Investcentre, we've got all the fact sheets and various information on there that is available quite easily. Thank you for listening to this second quarter 2022 presentation for the Model Portfolio Service. I will see you in quarter 3.